Hi and welcome to this video brought to you by Blueberry. My name is John, Senior Market Analyst. In this video, I'm going to discuss what happens to markets when central banks cut interest rates. A central bank can use the tool of interest rates when an economy is blowing hot or cold. When a central bank cuts rates, it's usually because the economy isn't doing so well or potentially falling into a recession. A key economic indicator to follow is inflation. This gives us a general idea of the prices of goods and services within an economy. If prices are falling, as supply begins to outweigh demand, then it could lead to lower inflation prices and ultimately lower interest rates. It's also important to understand the relationship between bonds and interest rates. If bond yields fall at the short end of the curve, then interest rates could follow. Long-term bond yields give more insight into the inflationary expectations of the future. So a central bank tends to focus on what is known as the short end of the curve. Lower interest rates can devalue a country's currency, as lower interest rates is less attractive to foreign investment, as they seek higher interest rates elsewhere. A great example of this recently has been the euro-US dollar price. The Federal Reserve are cutting interest rates alongside the ECB, but they are doing it at a less aggressive pace. And in turn, the euro has devalued against the US dollar. Lower interest rates also encourage businesses to borrow, as it's cheaper for banks to lend capital. Lower interest rates can typically be positive for businesses, and we often see stock markets perform better in those conditions. So in summary, cutting interest rates can correlate negatively with currencies, but can encourage growth within an economy and be positive for stocks.